Okay, in this video we're going to be looking at how the government can change the tax mix or give businesses tax concessions to try and boost aggregate supply. So first of all, tax concessions, it's really important that you can define this really succinctly, and it's basically in the form of rebates or allowances where businesses are able to reduce their tax liability by claiming inflated tax deductions for investment in specific assets or activities. So basically what it is it's reductions in tax for businesses if they invest in certain areas or activities. It's important because it decreases the costs of certain things, particularly investment in areas with positive externalities. So for example, research and development tax concessions are designed to boost investment in innovative ideas and ways to produce. So the idea of it is if you spend $5,000 on research and development, then what you can do is you can claim that as an expense, but rather than just claiming the $5,000 as an expense, you might be able to claim 175% tax concession, which basically means you can claim approximately $8,000 to $9,000 as an expense, which reduces your total level of tax and basically means that you pay less tax and therefore you're more willing to invest in that area. So tax incentives are designed to boost aggregate supply. They also boost aggregate demand because they will encourage investment spending in the short term. So they encourage entrepreneurial behaviour. They can be used to they can be used for innovation and investment. This innovation and investment also has positive externalities for a society because other businesses will be able to benefit from those new innovative ways of producing. And the whole idea is that will boost the productive capacity of the nation, as well as incentive to increase effort and productivity. So tax concessions are different to tax cuts. Tax cuts can also be used to try and improve conditions as well. Rebates are basically exactly the same as tax concessions. They basically allow businesses to deduct more than they need to for certain areas. So tax breaks work like research and development tax concessions, offering businesses an additional deduction on top of their allowable deduction to encourage investment in certain assets. But basically, if they purchase certain assets, they're allowed to depreciate them quickly. It would be a depreciation allowance. It's a form of rebate, or allows them to pay less tax if they purchase certain assets. With depreciation allowances, this is a really current thing, so it's really important. It's basically like saying businesses that buy assets. So if I buy an asset worth $10,000, I can depreciate the whole thing straight away, and therefore I can reduce my effective profits by $10,000, which means that I will be paying less tax because I can reduce my profits by $10,000, therefore I'll be paying approximately $3,000 less tax. So the idea is you can depreciate your assets straight away, which reduces your profits and therefore allows you to basically pay less tax, which is an incentive to invest in new capital and technology. Direct taxes can also be changed to try and affect the policy mix. So for example, the government might reduce company taxes. That promotes investment spending. It also attracts foreign investment, which are both good for productive capacity in the long term. They also stimulate aggregate demand in the short term because they promote investment, but in the long term, the more businesses invest, the more productive they are, and that boosts our long-term sustainable growth. In terms of income taxes, this should be revision, but income taxes can also boost supply. One, they increase the incentive to work harder and increase people's willingness to gain skills and training. They increase the size of the labour force, because they encourage people to join the labour force because they are paying less tax. They also can lead to increased immigration because more people want to come here because they are paying lower tax rates. This leads to downward pressure on labour costs as there are less labour shortages, so there's increased supply of labour that keeps wages down and therefore lowers firms' cost of production and makes them more willing and able to supply. Sole traders also benefit. Sole traders are people that own their own businesses. They pay income tax like everyone else. They don't pay company tax. So when they have an income tax cut, they've got a higher disposable income and they're more willing to invest in new things like machinery and equipment and things like that to run their small business. You'll also hear the word compliance costs. Compliance costs basically represents the paperwork that businesses have to fill in. So it's all the administrative costs associated with running a business that businesses have to deal with on a day-to-day basis. So reducing compliance costs reduces firms' costs of production and also makes them more willing and able to supply. The government can also use the tax system to promote efficiency or equity. So for example, lowering income taxes and increasing the GST is an example of promoting efficiency over equity. It promotes efficiency because there's a greater incentive for people to join the workforce. If it's lower company taxes, it leads to increased investment spending. If it's lower income taxes, it leads to an increased incentive to work hard. But if we do swap that tax with a higher GST, it will have regressive effects on the economy and can hurt particularly low income earners. But it doesn't have those same, higher GST don't have the same negative impacts on the supply side of our economy because people won't, it's not a disincentive for people to work putting a GST on things. So just to sum up, all money from the GST is allocated to the states. Increasing the GST may boost efficiency but hurts equity, or broadening the base of the GST, which means that you're putting it on more goods like healthcare and education and things. The government may lower income taxes, which will boost productivity and aggregate supply. So in essence, we're trying to achieve greater efficiency, but doing it at the expense of equity.